welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. This is the show where we talk all about mutual funds and how they can be a great investment for you. Today, we're focusing on ETFs or exchange-traded funds. We're asking, are ETFs a good option for you? We break down their pros and cons, and especially right now in a period of volatility. We explore how they stack up against mutual funds and help you decide which investment vehicle suits your financial goals best. To speak on this today, I'm joined by Prableen Bajpai, founder of FinFix Research and Analytics, and Nikhil Kothari, director of Etika Wealth. Welcome to both of you, and great to speak to you on the show. Prableen, let me begin with, and we'll just start with the basics. What exactly is an ETF and why are they popular?
Good afternoon, Tamanna. Thanks for the invite for the show today. Exchange-traded funds, as the name suggests, so they can be traded on the exchange. It is a fund, so it constitutes a number of stocks when it comes to an equity-oriented ETF. So there is an underlying composition, and it tracks an index or a commodity. So broadly, ETFs are a basket of securities that are tradable like a stock, but the composition is more like a mutual fund because it's diversified. In India, the first ETF was launched in the year 2002, and we saw that for more than a decade, there wasn't much activity. ETFs were recognized as an asset class only in 2013, and the progress in this segment where ETFs started becoming popular began when EPFO started to allocate money towards ETFs, which was in 2015. And now approximately 15% of the funds are allocated. Today, passives, ETF funds is a kind of a passive fund. So passives overall in India are now almost 17% of the overall AUM of the industry. And ETFs alone are approximately 70% of that. So Tamanna, overall, ETFs are a great strategy for investors who are looking for a transparent, low-cost medium to invest in the markets, but it's a passive way of investing. So broadly, you're going to get the returns of the underlying index or the commodity or the security which is being tracked. So in case it's an gold ETF, so you're tracking the price of gold. If it's an ETF which is tracking Nifty 50, you would replicate the performance. So you're tracking the underlying security or the index, and of course it's tradable. Those are the main two features of an ETF.
Okay, so now let's put that in context. Nikhil Kothari, great to have you on the show. Why an ETF versus other kinds of passive funds, or even versus other categories of mutual funds?
Okay, so as was rightly mentioned, that's a passive-oriented fund. So you don't take a fund manager risk. You know that what is the stocks are in this portfolio, and the fund manager is just going to buy those stocks accordingly. And depending on the stock movement, the NAV of the price of the ETF will move. Now, comparing to index funds, so how ETFs are superior? There are two reasons. One is the cost is lower for ETF as compared to index fund, because many of the index fund just go and invest in the ETF. So there's a two line of expenses in case of index fund, whereas in ETF, there's only one line of expenses. Second reason why people prefer ETF, because you can buy ETF during the day in terms of market thing. So say, for example, 2 o'clock, the markets are down and you want to invest in Nifty, or right? So if you buy through a mutual fund, you will get the day ends NAV. So say, for example, market was down at 2 o'clock, but market recovered 3:30 again. So when you invest in mutual fund, you get a day's end NAV. Whereas in ETF, you can buy during the day. So if you want to buy and sell, or if your markets are dipped and you want to buy on that particular time frame, then you can use ETF as a far better alternative as compared to the index funds or mutual funds. So if someone wants to have a passive, he has a demat account. That's most important for ETF, because you need to have a demat account to buy ETFs, and you want to and one wants to buy for long term, can invest in ETF as a option. And nowadays, you have a wide variety of ETFs. You have large cap, you have Nifty, you have Sensex ETF. Apart from that, nowadays you have lot of smart beta ETFs, which is basically low volatility momentum ETF, and then you have sector-based ETF also. So from an investor perspective, there are lots of variety of ETFs available now.
Prableen, let's come to the basic difference between an ETF and an index fund, because if the idea is to not take risk and just bet on the underlying asset, then both could have a bit of an overlap and have the same purpose, isn't it?
Absolutely. So, Tamanna, the broader difference is that, see, they both are representing the passive strategies, just the structure is different. So, you cannot trade an index fund. You are only buying it at the NAV, end of the day NAV. But like Nikhil mentioned, you can, we trade an ETF. So, you have the option of not only buying it at the end of the day price, the NAV, but you can trade it during the day. And if like yesterday we saw the markets were going up and then by the end of the day there was a correction, so ETFs give you that opportunity to do that buy and sell during the trading hours. That's the main difference between the two. The second difference here, I think, which is important, is that you would require a demat. So the structure is different. So an ETF has to be in the demat. So if in case investors are already trading, they have their brokerage accounts, then demat facilities available to them, and they can choose the ETF strategy. If somebody is looking to do an SIP and invest through this medium of doing their monthly allocations, then I think index funds would be preferable for them. So a lot of large investors who are wanting to take the high net worth individuals and more savvy investors who are looking to take advantage of the dips during the day, I think they prefer the ETFs. Otherwise, even for retail investors who do have the facility of demat, they can definitely choose the ETF option, but they would require a FOF or a fund of fund to do an SIP, because SIP is one of the most preferred options of investment these days. Other than that, one big difference is that the ETF, the holding period, Tamanna, for taxation now, when you get taxed at that 12.5%, for whether it is a gold ETF or any other ETF, the holding period becomes 1 year. So the taxation remains same for an index fund as well as an ETF. Just the holding period difference is for everything else, it's 2 years. For an ETF, even if it's not equity, it becomes 1 year.
Yeah, so that becomes an advantage if you
Yes,
invest in an ETF, isn't it? Yes, Nikhil, you wanted to come in.
absolutely.
So I'm saying that's a one basic advantage is taxation, what Praveen rightly say. But one thing which I want to very, very highlight to investor is that ETFs are not so simple that just you can go and buy any ETFs. One of the major problem in ETFs is the tracking error and the volume, right? So many times what we realize that the price which is quoted in the market, there's a huge difference between bid and ask price. Okay, so you may say that, okay, I'm going and buying an ETF, but at times even the markets are up because of low volume in the ETF market, the price may be far, far different than what the underlying index price should be, right? And because of that, you may, if you place a market order, like if you want to buy during the market, and you may end up buying at far higher price or far lower price, or you may end up by selling at far lower price. So one has to be very, very careful when he's buying an ETF in terms of the bid and ask spread between the buyer and the seller. And based on when he's placing the order, he has to be very, very careful. Whereas in case of index fund, it's very simple because they will buy the index. They will buy first high liquidity index, and here you will always get the return in line with the index performance. Whereas in ETF, your buying and selling price makes a huge difference in terms of your return.
Okay, so those are some basic differences between an ETF and an index fund. The recent tax changes also makes ETF attractive, so that's an important portion. Now let's come to whether ETFs are a good option right now and for whom. And probably let me start with that. The context also, because we're seeing a lot of volatility right now. So for which category of investors does ETFs make sense?
Tamanna, I'll club ETFs and like passives together, because I think the main advantage of passive investing is that it's very simple to understand. So, for example, on Monday, the 5th of August, the market fell. So, when you're buying at low markets. When you're buying an active fund, it may be possible that the composition of the portfolio is very different from the, index that it's going to track, the broader index. For example, an active fund will have a very different composition from the Nifty 100 or Nifty 50 for that matter. So I think for investors who are looking at very long-term investing, want a very simple strategy, do not want the fund manager's bias, or are wanting to be away from that basic problem of whether I am investing in the best performing, let's say, large cap fund, or am I investing in the best performing mid cap fund, they should choose the ETF or the index fund option. I think because it's a very simple, transparent, low cost strategy for the long term. So for any investor, be it today's markets or otherwise, Tamanna, I feel that the core of your portfolio should now be built with passives. As India becomes a developed economy, I think the rise of passives will only grow stronger. So I think the core should be passives, and then you complement it with other active funds which are available to us. Currently, I think the large and the mid cap space, definitely a passive strategy can be picked via an ETF or an index fund.
Nikhil, that's interesting. In context of volatility that we've seen recently, do ETFs become more attractive or a good choice? If so, then for whom?
So as Praveen rightly said, that you need to have both the strategy in the portfolio, passive and active. Okay, so for passive strategy, if you have a demat account, then you can use some part of your portfolio, like a large cap. On a large cap space, you can have 60-70% of your portfolio through ETF or an index fund, and 30% of your portfolio can be through active funds. Whereas in mid and small cap, right, where the alpha generation can be, where there's a huge variety of stocks which they can buy, and there's a scope of alpha generation. There the 30% of your portfolio can be in ETFs or an index fund, and 70% of your portfolio can be in a active managed fund. So from an investor perspective, you have to balance both the things. Apart from that, there are few specific sector ETF. So if those ETFs are available and the investor wants to take a call on this particular one sector, like say for example, there's a private bank ETFs, there's a PSU ETF, so there are a lot of other sector-based ETF. If an investor who is very smart and who has experience in the market and wants to take a call in a particular sector, then he can buy those ETFs and add as a tactical call to his overall portfolio. But as Praveen already said, some part of your portfolio can be passive, which is through ETFs, and remaining can be active managed funds.
Swastik writes in, aged 48, and says, I've invested around 2 lakh rupees in mutual funds during Corona period, and now the fund value is more than double. Should I exit or stay invested? Well, first of all, congratulations, Swastik, for continuing your investments during what was a very uncertain and tough time. It's obviously worked out well for you. Prableen and Nikhil are joining us on the show today. Prableen Bajpai and Nikhil Kotari are continuing with us and taking your answers. Nikhil, let me start with you first. He's asking, should I now exit or stay invested?
Okay. First of all, Swastik, it was a great call, which Taman already said that it's very difficult to invest when the markets are down. And when you invest that point of time, right, and if you have patience to stay invested for 4 or 5 years, we have seen the result that how equity market gives you a very promising return over a long period of time. Okay. Now coming to the question that should I redeem? Now you should only redeem if you need the money. If you do not need the money, next 5-7 years, India looks a very good story, or equity markets over a long period of time can give you better return on a post-tax basis as compared to traditional investment plan, but you need to have a very long-term horizon of another 5-7 years. So if you have a long-term horizon and if you do not need the money, I will rather recommend that you continue to stay invested. But if you need the money next 6 months, 1 year, 1.5 years, then I recommend that you can take out this money and move to a liquid or a arbitrage fund and then redeem whenever you actually need the money. So your your withdrawal should not depend on return you've already made. Your withdrawal also should depend on when you need the money. Right, depending on when you need the money, you should be able to withdraw the investments.
Okay, so if you don't really need the money right now, maybe you should not exit. Prableen, do you second that?
Absolutely, Tamanna. I feel that an exit strategy is more important than when to invest, because a lot of investors are unsure of whether they should redeem when they are in having profits. So I think if the goal is close by and it's 6 months or a year away, definitely book your profits. And if you do have the long-term horizon, then continue. But because we don't know the name of the fund, let's say it's a thematic fund or something where you have made money and which is a risky bet and probably doesn't suit your risk appetite, maybe the call would be different. But I think, yes, like Nikhil mentioned, it's broadly based on whether you need the funds or not.
All right, Fiza writes in, age 28, says, I'm invested in the following funds on a lump sum worth 1.68 lakh rupees, and my goal is to reach 2 lakh rupees in a short-term basis. Am I reading that right? Yeah, 2 lakh rupees on a short-term basis. Is it a viable goal? And look at her funds: SBI PSU Direct Growth Plan, Aditya Birla Sun Life PSU Equity Fund, Invesco India PSU Equity Fund Direct Growth Plan as well. So pretty well laid out, but a lot of focus on PSU, at least 2 PSU funds over there. She has not defined what is the short-term basis, Prableen. So, assuming about 6 months to a year, do you think that this is an achievable goal?
Firstly, Tamanna, that I think somewhere FISA has fallen for the recency trap, because this category, the whole category of PSU, has done exceptionally well, and all the 3 funds are broadly covering that. So you'll have NTPC Coal India, REC, HAL, names like these, in all these 3 portfolios. So the money is really concentrated in this sector overall. So having a short-term view in the equity markets, it's not a very wise idea. If the markets do well, of course, she can reach a target of 2 lakhs. That shouldn't be a problem. But if we see, any sort of a sharp correction, then of course she's taken much away from the goal that she's set for herself. So ideally, my request to FISA would be to look at investing in equity only for the long term. And if she understands the risk and she's okay to take the bet to stay invested for a short time period in these funds, which are broadly thematic, then that's fine if that suits her risk appetite. But it's not the way you should be investing. And also now, if it's going to be short term, then her taxation will be high at 20%. That also is something that she should consider.
Okay, let's go across to Poonam Patel's question. She's aged 50 and says, I'm an NRI who's looking to invest 20 crore rupees. Can you recommend any ICICI Prudential specific funds to invest in? Thus far, we have invested in the ICICI Prudential Business Cycle, India Opportunities and Energy Opportunities Fund. That's a recent NFO, and a FlexiCap multi-asset fund. All right. So, Ms. Patel, thank you so much for writing in for us. Nikhil, let me take that question to you. What I found interesting is that the viewer is asking for recommendations from one specific fund house, possibly because it's been easier so far or they've had a good experience. But do you think there is any reason to stick to only one particular fund house?
So first of all, when you're investing your money, you should be investing in 4 to 5 overall schemes, and that money has to be divided into different categories of fund and different fund houses. The reason being is that one fund houses may have a slightly bias towards one particular strategy, and then all your funds will in that fund houses will follow similar strategy to some extent, not completely. So in that case, if the sector does very good, or if the strategy does very good, all the funds will do good, and vice versa. So I recommend that first of all she should divide into different categories of fund and then to different fund houses. Now coming to only specifically ICICI fund house, she already have 4 funds in a portfolio. It doesn't make any sense to add any more fund in from the same fund houses to the portfolio. If she wants to only invest in ICICI, then I'll rather recommend that invest in the additional money in the existing fund only, which is Business Cycle Fund, India Opportunity Fund, or a FlexiCap fund. If she wants to add another fund on the overall portfolio, then she can look at from some other fund houses.
Okay. What about to you, Prableen? What would be your advice?
I'll concur to what Nikhil said, that, number one, that your investments must not be concentrated in the same AMC, Tamanna, because the strategy, the fund investment style will broadly be the same. But if in case she is keen to invest in ICICI, then I would say that now she needs to add the passive strategies, because even if it's ICICI, because it will be the passive strategies, the fund house, the relevance of the fund house, it reduces. AMC wise, ICICI has a decent corpus that they are managing assets in the passive base. So I think you can look at the mid cap index, some passive strategy, the momentum strategy from the ICICI AMC. That will reduce the risk that is there in a portfolio, which is being brought in with the same investment style from the AMC.
Okay. Uttam writes in, aged 60, says, I'm investing in 2 types of funds, hybrid aggressive funds and a balance advantage fund. Investment value is 50,000 rupees a month, and my goal is a corpus of 50 lakh rupees in 5 years. First of all, does that math add up? Prableen, let me come to you on this.
Sorry, Tamanna, what is the amount that he's investing? 50,000.
50,000 rupees, and his goal is to get 50 lakh rupees in 5 years.
Okay. That definitely is a steep target for the hybrid category, and he is going to take, that'll probably require him 7 to 8 years to achieve his target. Given that we really don't know where the markets would be heading in the coming years. But if we take realistic estimates of, let's say, 11 to 12% returns, he would require to extend his investment horizon by a little. Otherwise, the hybrid aggressive and the balanced advantage categories, I think, are very suited for the current market type, and they would reward him even if the markets, go up from here, and will reduce his downside risk as well if there is a correction. So overall, the strategy is great, but I think he'll have to extend his investment horizon by a little.
Okay. One quick question before we wrap up the show today. Siddharth, age 25, asked, should I shift from my small cap to contra funds in the current market landscape? Good question, Siddharth. I'll ask Nikhil to take that. Considering that there's a bit of volatility and small caps have been very, very popular, have given great returns, is it a good time to look at a contrarian bet?
Yeah, so in the current context, though I don't know his overall portfolio, but if I take a specific case, moving from small cap to contra, I think it's a good bet because small caps are, from a valuation perspective, are quite expensive as compared to other categories of funds. So from a risk reward perspective, I think contra funds seems to be suitable bet as compared to small cap funds in the current market.
Okay, so contra funds would be a better bet than small cap funds in the current market. Well, that's all the time we have on the show. Do write into us if you want our experts to answer your queries. The numbers are on your screen. But for now, thank you so much, Nikhil. Thank you so much, Prableen, for joining us and taking all of our questions. That's all the time we have on the Mutual Fund Show for today. But stay tuned. A lot more coming up on NDTV Profit.